You earn decent money, but every time your bank balance starts to climb, something pulls it back down. A higher salary gives you more raw material to work with, but if your underlying retention structure is broken, that extra income simply drains away. Over the next 6 minutes, we are going to build an automated cash flow system. We will map where your money is actually going and redirect it so your finances run on predictable mechanics rather than reactive spending. To set this up, you only need 2 things: access to your online banking platform and your raw transaction history from the last 30 days. Psychological research shows that willpower is a finite resource that depletes under stress, fatigue, or hunger. When a financial choice depends on how you feel at the end of a long day, the impulse for immediate relief often overrides long-term stability. Shifting those choices into a mechanical system removes that daily friction. Step 1 is clearing the financial fog. Pull up your bank statements for the last 30 days. You cannot command what you refuse to observe. This diagram divides your spending into 4 specific quadrants based on necessity and predictability: essential fixed, essential variable, non-essential fixed, and non-essential variable. Essential fixed covers non-negotiables that cost the same every month, like your rent. Essential variable includes necessities that fluctuate, like groceries. Non-essential fixed reveals hidden leaks, like forgotten streaming subscriptions. Finally, non-essential variable catches convenient spending, like dining out. Organizing your raw transaction data into these 4 categories converts unknown leaks into visible data points. The anxiety that comes from not knowing where your money went begins to dissolve the moment you map it out clearly. When income increases, spending will naturally adapt. The apartment gets upgraded, the car gets replaced, and weekend habits get more expensive. This pattern is called lifestyle inflation. It is the process where expenses expand to consume higher incomes, locking you into a life that requires constant performance just to stay afloat. This line graph shows an income line rising over time, while the expense line stays perfectly flat. To achieve this, you need to calculate your personal definition of enough, a specific monthly number that covers your essentials plus a capped amount of joyful spending. Holding your expenses flat while your income grows creates margin. That margin is the exact capital required to fund future investments and debt payoff. Defining exactly what is enough establishes a strict structural ceiling over your spending. It protects future raises from being quietly absorbed by upgraded lifestyle habits, ensuring that new income actually builds wealth. Most financial stress does not come from massive unexpected catastrophes. It is triggered by predictability, specifically predictably unpredictable bills like annual car maintenance or medical copays that you know will happen eventually. To neutralize these shocks, you need a buffer account. A buffer account is a dedicated secondary savings vault designed strictly to absorb irregular expenses so they don't disrupt your primary checking account. This equation shows exactly how to calculate your buffer. Add up your estimated yearly costs for car maintenance, medical visits, annual subscriptions, and holiday spending. Then divide that total by 12. That calculation gives you a monthly baseline. You now know the specific dollar amount you must set aside every 30 days to cover an entire year's worth of irregular bills, and the system routes that target amount directly to the vault. Open a brand new, separate bank account today. Its entirely designated purpose will be to house this exact monthly buffer amount. Structurally separating these irregular expenses from your main checking account isolates the risk. When your car needs a repair, the buffer handles it instantly, preventing a minor mechanic bill from snowballing into a monthly budgeting crisis. This flowchart maps the sequence most people are taught to use. The paycheck arrives, bills and wants are paid, and whatever is left over gets saved. Because expenses expand to fill available income, there is almost never anything left. The automated system reverses the sequence. The moment money enters your account, it is forced into its designated jobs, your savings and your buffer, before any discretionary spending can occur. You only spend what remains. Log into your banking app and set up recurring transfers. Schedule them to move your savings and buffer amounts one day after your paycheck arrives. By programming a digital workflow, you make the correct decision once while you are calm. The system then executes that decision automatically, entirely removing the need for daily self-control. Relying on good intentions at the end of the month leaves savings vulnerable to daily stressors. Automating your allocations separates your long-term goals from your immediate emotional state, ensuring your savings grow regardless of your energy levels or mood. Once the architecture is in place, you must establish a sustainable monitoring rhythm. There are two extremes that destroy financial systems: complete neglect, where subscriptions slowly pile up, and anxious daily micromanagement that exhausts your attention. You need a strict, low-effort maintenance schedule. This ensures you catch slow drift and misalignments in your allocations without letting money consume your daily thoughts. This is your schedule. Dedicate exactly 5 minutes every week to quickly scan your accounts for unexpected charges. Then set a 30-minute block once a month to verify your automations ran correctly and your spending stayed within its target margins. Restricting your check-ins to these specific time-boxed reviews preserves your cognitive bandwidth. It allows you to trust your system is working, rather than constantly refreshing your bank app out of background anxiety. When your automations are active and your buffer is funded, your income is mechanically managed. Money arrives, filters into its designated jobs, and covers your obligations without requiring a single manual action. At this stage, your metric for success shifts to process integrity. Process integrity measures whether your system ran exactly as designed this month, rather than focusing on short-term fluctuations in your net worth. Start building this architecture today. Log into your bank account right now and set up one automatic transfer to your savings or buffer, even if it is just $20 a month. An automated, predictable structure allows the nervous system to remain in a state of calm. When bills are handled and savings build on autopilot, the mental bandwidth once consumed by money worries becomes available for the life those resources actually fund.